All right, let's talk about a common trap every trader has fallen into at some point: obsessing over the perfect entry. You know the story. You see flashy ads promising that if you just master this one entry technique, you'll make easy money. But let's get real for a second. If it was all about getting the perfect entry, why do so many traders still fail? The truth is, focusing solely on your entry is not only misleading, but it can also set you up for failure. And there's a reason why so many traders get stuck in this cycle. Let's break down why that is and what you should be paying attention to instead. Here's the harsh reality. You can have a picture-perfect entry, but it doesn't mean you're guaranteed to win. The market is unpredictable, and it can turn against you in a heartbeat. You might enter at a strong support level, and guess what? Still breaks through and stops you out. That's because the market doesn't care about your entry. It cares about momentum, news, and a whole bunch of other factors that no one can control. If you're banking on your entry alone to win, you're missing the bigger picture. Think about it. If a market sentiment changes due to unexpected news, your entry position doesn't matter. The market's going to move based on what's happening in the world, not on the pretty pattern you spotted on your chart. And this can happen anytime, whether you're trading stocks, forex, or even crypto. The markets are volatile, and there's no single method that can promise a win every time. Price action, moving averages, trendline breaks, Fibonacci retracements. Every trading guru has their favorite, and they all claim theirs is the best. But how do you know which one to trust? Are they all right, or are they all wrong? The problem is, focusing too much on finding the perfect method distracts you from other crucial parts of trading. And let's be honest, some of these entry methods contradict each other, so which one should you actually follow? One day you're trying moving averages, the next you're experimenting with candlestick patterns. It's a never-ending loop that keeps you chasing the next best thing, instead of learning how to make a strategy work for you. And this constant jumping from one method to another is exhausting. You end up overcomplicating something that should be straightforward, and that's when you lose sight of your trading plan. To avoid bad trades, traders often start adding more and more filters, different indicators, oscillators, or complex rules. You end up with a chart that looks like a conspiracy board, and suddenly you can't find a single trade to take. Or worse, you see setups that meet all your conditions, but by the time you enter, the market has already moved. This overcautiousness means you're stuck on the sidelines, missing opportunities. More filters don't necessarily mean better trades. They can just lead to analysis paralysis. Think of it this way. If you have 10 indicators on your chart and 9 of them say buy, but one says sell, what do? You hesitate, and while you're stuck debating, the opportunity is already gone. The market doesn't wait for you to make up your mind. Having too many filters makes you second-guess yourself, and second-guessing in trading can be fatal. I get it, the idea of a holy grail entry method is tempting. But let's be real, it doesn't exist. Some traders spend years jumping from one strategy to another, convinced that the next one will finally unlock the secret to the markets. It won't. The market is too dynamic and unpredictable for any single method to work 100% of the time. The sooner you let go of the idea of a perfect entry, the better off you'll be. There's no secret formula hidden behind paywalls or locked in expensive courses. What you need is a solid understanding of how the market works, how to manage risk, and how to execute your plan consistently. The Holy Grail isn't an entry method. It's having a balanced approach. Instead of obsessing over the perfect entry, shift your focus to the exit. Why? Because the exit is what determines your profit or loss. You can enter at a mediocre point and still make a profit if you have a solid plan on when to get out. Know your targets, set realistic goals, and have a plan for when things don't go your way. It's the exit that truly defines your success in the market, not the entry. Think of it like this. Would you rather have a perfect entry that goes nowhere, or an okay entry that leads to a profitable exit? The answer's obvious, but for some reason, traders fixate on the entry. Start planning your exits just as carefully, and you'll see a difference. Before you even think about entering, you need to determine if the risk-reward ratio makes sense. A good entry without a solid risk-reward plan is like getting on a roller coaster without knowing if there's a safety bar. You might be in for a smooth ride, or you might get thrown off. If your potential reward doesn't justify the risk, why take the trade? Simple, you're not here to gamble. You're here to make smart, calculated decisions. For instance, if your risk is $100 but you're only aiming to make $50, then you're playing a losing game. It doesn't matter how perfect your entry is, you're not going to last long in this business with bad risk management. Instead, aim for setups where the reward outweighs the risk by at least 1.5x, 2x, or even more. Every asset moves differently. Forex, gold, indices, they each have their own personality. If you don't understand the typical movement of what you're trading, you're fighting blind. You need to know what normal looks like on a quiet day and how it behaves when big news hits. For me, it's all about price movement percentages because that gives you a clearer picture of what to expect than just looking at pips. For example, Euro USD. During quiet hours, it usually moves around 0.28% or less. When it hits 0.5%, it's quite active. But during major events like NFP, non-farm payroll, it can spike to 0.7% or more. That's what I'd consider volatile. If price movement percentages feel too technical, you can always use the ATR average true range and measure it in pips instead. It's essentially the same thing. Why is this important? Because knowing these numbers helps you set realistic expectations for market movements. You can't expect massive swings in a day if the market typically moves at a slower pace. Not understanding this can lead to bad trade management. You might set tight stop losses that get triggered too easily, or you might expect huge moves that are unrealistic. Knowing how an asset behaves allows you to set more appropriate targets and stops. Speaking of realistic market movements, now that you've learned how to gauge the behavior of your asset, you need to set your exit within those boundaries. Let's say you want to take a 200 pip profit on Euro USD. Well, here's a reality check. Euro USD doesn't typically move 200 pips in a day unless there's some major event. On a regular day, it might move 20 to 50 pips. So, if you're setting a 200 pip target and expecting it to hit in a single day, you're setting yourself up for disappointment. Be realistic. Based on historical data, that 200 pip move could take anywhere from 4 to 10 days. If you're impatient and set your expectations too high, you're going to get burned. Take a step back and look at the bigger picture. If your target isn't achievable based on what the asset normally does, you need to adjust your plan. Otherwise, you're just chasing dreams instead of making solid trades. So there you have it. Stop falling for the illusion of the perfect entry and start seeing the bigger picture. If you're only thinking about when to get in, you're missing out on everything that happens after you're already in. Focus on your exits, understand your risk-reward ratios, and take the time to learn the behaviors of the assets you're trading. That's how you can give yourself a real edge. If you found this useful, hit that like button, drop a comment, and subscribe. This is Bear's Take, and I'll see you in the next video.